Well, welcome, and today we are going to be talking about your credit score, or as it's commonly known, your FICO score. The reason we want to talk about this is because your credit score is really a huge indicator to banks and financial institutions on how trustworthy you are if you are looking at applying for a car payment, a new credit card, or are thinking about purchasing a home and need a mortgage. Now, most people are probably concerned about also improving their credit score as well, but first, it's a good idea to start off with understanding these details because financial literacy is so important. And by doing this, it'll put you in a better situation when it comes to applying for your next mortgage or in the process of improving it to that point. Hi, I'm Jake Tysiak, that guy that sells houses, and I'm a realtor here in Illinois. Now, obviously being a realtor, we deal a lot with financing, but personally, I've been very invested and curious on developing my credit score and really understanding it. And it's made some huge progress over the past few years, and I think a lot of people can benefit, and I do applaud you for taking the time to really understand what is involved with your credit score itself. So today we're going to be talking about 5 different factors that are included into your credit and sort of how they look at it and why. Now, one of the things to really keep in mind is there's a lot of tools out there that you can help to research and look at what your credit history has been doing, your credit report, and then also how that's going to be reflected on your FICO score. So keeping in mind with that, we're going to start off with a few items that are a little bit lower effects and build on that. Starting off with credit mix. So oftentimes lenders like to see, as well as the credit reporting agencies, like to see a good mix of credit that you're utilizing. So installment loans like student loans or credit cards make up 2 different varieties. Also, if you have a car payment, which is secured by some collateral, your car, that's another great opportunity. And of course, if you do have a house and are utilizing a mortgage, that's a whole nother different avenue as well. And by being able to juggle all these different credit options and making responsible payments, it looks favorably upon your credit score itself. Now, our second factor is the age of your credit accounts themselves. So if you think about it, it's pretty logical. The longer you have an account open with a creditor, the more history that they have to gauge your performance on. And of course, if you're in good standing, they're going to keep your account open, where if you are behind and lagging, they're more likely to close your account. So by simply having your accounts open for a longer period of time, this is going to have a positive effect on your credit score too. Now, our third factor on our credit report is going to be new credit, or sometimes called hard inquiries. Now, what I mean by that is when you apply for new mortgage, it's going to report on your credit history, and that new inquiry is going to possibly lower your credit score for the interim. So if you go out there and are applying for lots of different credit applications, like a new car or new furniture credit card, as well as a mortgage, they're going to be looking at that with some negative effects to it, because it looks like you're applying for a lot of different credits, and that can really change some of the other factors that we're going to talk about in a moment. But if you are out there, say, shopping for a new car, but you talk to a couple different banks, like 4 or 5 different banks, so you can shop and compare the interest rate, they understand that, where chances are you're not going to be buying 5 cars. But if you are applying for new furniture, a new car, and a new house, there's a good chance you might be actually trying to purchase all of those items, and that could affect your credit history and score. Now, our fourth factor when we're looking at our credit score is going to be your credit utilization. Now, this is really an important one to look at because you have quite a bit of control over this. Now, what I mean by that is what credit card companies and lenders want to see is the amount that you're borrowing in relationship to the amount you can borrow. So this is mostly tied to credit cards. When it comes to credit cards, a good rule of thumb is you want to make sure that you're not using more than 30% of your available credit. There's 2 forms to this. In general, with all your credit card combines, but it's also a good practice to make sure that when you are individual credit cards are underneath that 30% as well. Lower the better. Now, usually with credit utilization, that has about a 30% effect on your credit score. And like I said, you can easily control this. So this is a really key one to pay attention to when you start managing your credit history. And our 5th one, which is our most obvious one, is going to be your payment history itself. Now, this accounts for usually about 35% of your credit score. So by making your payments on time, you're going to keep your history in good standard. Now, keeping in mind, there's a couple different factors with your credit history itself. So your due date, if you're a couple of days late past that, it's probably not going to negatively affect your credit score. What most credit reports are going to be looking at is once you're 30 days late, that's going to have a negative effect on your credit report. If you're 60 days late from that payment, that's going to have a worse effect, 90 days and up to 120 days. This is really when you get in a lot of trouble. So by simply making your payments on time, not only are you going to keep your finances in line by avoiding paying late fees and things like that, but you're also going to build your credit history and report. Now also keep in mind factors like a foreclosure or bankruptcy are going to have a major impact, but these are going to be more of a reset than an effect on your credit score. So those are the 5 factors that are tied to your credit score. And if you're curious about how you can actually improve those, consider subscribing because our next video is going to be going over exactly that. But if you are thinking about buying or selling a home and are looking for an agent, feel free to give me a call. I'm Jake Tysiak with Keller. Thank you so much for watching. I'll see you in the next one.